People chase a 10% dividend yield because it feels exactly like a paycheck. The problem is, a yield that high is usually a giant red flag. There are three specific yield traps investors fall into every month. We'll expose them right now. Passive income is the ultimate financial dream. Dividend investing feels like the safest and most logical way to get there. You buy a stock, and the company deposits cash directly into your account every quarter. It feels a lot like earning interest in a high-yield savings account. It feels secure. When you look at a list of top dividend stocks for March 2026, you will see yields of 8, 10, or maybe even 14%. If you put $100,000 into a 10% yielding stock, you expect $10,000 a year in cash. That math makes early retirement seem incredibly easy. But that feeling of safety relies on a few completely invisible assumptions. You are assuming the dividend payment is actually sustainable. You're assuming the underlying business is healthy enough to keep operating. You're also assuming the stock price won't quietly collapse while you are distracted by the payout. Reality breaks those assumptions constantly. Dividend yields and stock prices move in opposite directions. Let's look at the simple math behind a sudden 12% yield. If a company pays $1.20 a year in dividends and the stock costs $10, your yield is exactly 12%. That looks incredible on a spreadsheet. But if that company's core business starts failing and the stock price drops to $5, the yield mathematically spikes to 24%. The company did not suddenly become twice as generous. The market is pricing in bankruptcy. That 24% yield is not a rare market opportunity. It is a warning siren. If you buy that $10 stock purely for its 12% yield and the price bleeds down to $7 over the year, the math is brutal. You made $1.20 in dividend cash, but you lost $3 in capital value. You're down $1.80 overall. That difference isn't abstract. That is your actual net worth evaporating while you celebrate a small cash deposit. This is the first of those three traps, the declining price trap. Investors blindly chase the high percentage and end up trading their principal for a tiny payout. Now, you might be thinking, as long as they don't cut the dividend, I don't care what the stock price does, because I am holding strictly for the income. If a company is paying out more money than it actually earns, the dividend cut is an absolute mathematical certainty. If a business earns $2 a share but pays out $3 a share, they are literally taking on debt just to pay you. That math lasts about a year or two before the board of directors is forced to slash the dividend by 80%. When they finally announce that inevitable cut, the stock price usually drops another 30 to 50% on the exact same day. You lose the passive income stream and a massive chunk of your initial investment at the same time. That loss directly hits your ability to sleep at night. Stress replaces the passive income dream because your financial margin of safety just vanished. If you look at the S&P 500, the average dividend yield right now is sitting around 1.5%. When a single company is offering you 8 or 9% in a low-yield environment, the broader market is screaming at you that there is massive risk attached to that business. There is no free lunch in the equity markets. Let's run a real scenario to see how this destroys wealth over time. Imagine you put $50,000 into a concentrated portfolio of extremely high-yield stocks paying 10%. You expect $5,000 a year in passive income to help cover your living expenses. But within 18 months, 2 of those companies cut their dividends entirely to avoid bankruptcy. 3 others see a 20% drop in share price because their profit margins collapsed. Your $50,000 of hard-earned capital is now worth $38,000. Your $5,000 income stream shrinks down to maybe $1,800. You didn't build a reliable income machine. You built a wealth incinerator. That $12,000 loss represents months of your life spent working a job just to get back to where you started. This brings us to the second trap, which is the payout ratio illusion.
I will show you the exact percentage that should instantly disqualify a stock from your portfolio in just a moment. Companies with truly sustainable dividends operate differently. They usually start with lower yields, but consistently grow their payouts over time. A 3% yield on a company that increases its dividend by 10% every single year is vastly superior to a stagnant 8% yield from a dying legacy business. Let's do the math on dividend growth. If you buy a stock at $100, paying $3 in dividends, your starting yield is 3%. If that company is highly profitable and increases that dividend by 10% every year, in 10 years they are paying out $7.78 a share. Your personal yield on your original $100 cost is now nearly 8%. Plus, the stock price has likely doubled alongside the growing earnings. That growing, reliable income stream translates directly to your family's optionality. You aren't just surviving inflation, your income is out-earning it without you lifting a finger. The second trap, the payout ratio illusion, is the easiest to avoid once you know where to look. The payout ratio is simply the percentage of total earnings a company pays out to shareholders. If a company earns $1 in profit and pays out 50 cents, the payout ratio is 50%. Anything above 75% is a massive warning sign. Anything over 100% means the dividend is on life support and the company is bleeding cash.
You can look up the payout ratio for any public stock in about 5 seconds on any financial site. If it is over 80%, you simply walk away. Now, you might be thinking there are specific sectors like real estate investment trusts or utilities that always have high payout ratios, so the 80% rule doesn't apply to them. The fundamental laws of business cash flow apply to every company on Earth, regardless of their sector. While a real estate investment trust is legally required to pay out 90% of its taxable income, a dangerously high yield is still a trap. If a commercial office REIT is paying a 12% yield, it is not a gift to investors. It is a reflection of half-empty buildings and plummeting rental income. If the cash flow doesn't cover the payout, the dividend will eventually be cut. You aren't earning a return on your investment. You're just getting your own capital handed back to you in taxable installments. That lost capital restricts your future mobility and limits your choices when you actually need the money. The third trap is the most subtle of all, and it has entirely to do with taxes. I will explain how you might be voluntarily giving the government a massive cut of your returns before we finish. If you want to build a dividend portfolio that actually works in the real world, you have to completely shift your focus. You must stop looking at current yield and start looking at dividend safety and growth history. You want boring companies that have a history of increasing their payouts even during severe economic recessions. Start small. Find one company with a starting yield around 2 or 3%. Make sure the payout ratio is under 60%. Look for a 10-year history of consecutive, uninterrupted dividend increases. Find a business that makes a physical product or provides a service people buy every single week, regardless of what the economy is doing. Buy one share. Watch how the dividend gets deposited into your account. Then watch how the company announces a tiny increase to that payout the following year. Once you understand the actual mechanics of dividend growth, you scale up. You start allocating a set percentage of your monthly income into a diversified fund of these dividend growth stocks. Instead of chasing a dangerous 10% yield from a failing telecom company, you accept a safe 2.5% yield from a basket of highly profitable businesses. This assumes consistent investing and not panic selling during market downturns. The stock market will experience severe 20% drops and your portfolio will lose value on paper. If you need this money to pay rent in the next 3 years, it absolutely should not be in the stock market. But over 10 or 20 years, those consistent growing dividends compound aggressively. You automatically reinvest them to buy more shares, which then produce more dividends. A $10,000 initial investment grows to $20,000, then $40,000.
The income stream quietly expands year after year. That compounding effect isn't just a trick on a spreadsheet. It is the literal mechanism that eventually buys back your time. It is what allows you to eventually choose whether or not you actually want to clock in on a Monday morning. That brings us to the third trap, taxes. If you hold high-yield dividend stocks in a standard taxable brokerage account, those payouts are taxed every single year. If you're a high-income earner in a high tax bracket, a seemingly great 6% dividend yield might only be a 4% yield after the IRS takes its cut. Let's do the math on the tax drag. If you earn $10,000 in non-qualified dividends and sit in a 32% tax bracket, you owe $3,200 in taxes that year. You only keep $6,800. You're taking on 100% of the risk of owning the stock, but you're only keeping a fraction of the actual reward. That tax drag doesn't disappear at the end of the year. It compounds against you over decades, stripping hundreds of thousands of dollars from your potential net worth. For high-income earners, sometimes a stock that pays zero dividends is actually mathematically superior. A company that takes its profits and buys back its own shares drives the stock price up without triggering an immediate tax bill for you. You control exactly when you pay capital gains tax because you decide when to sell the shares. Chasing a list of the top 10 high-yield stocks for any given month usually just means you're buying a list of the 10 most troubled companies in the market. A massive dividend yield isn't a guarantee of future income. It is almost always a warning about the underlying fragility of the stock price. The goal of investing isn't to get the highest immediate payout on day one. The goal is to build a reliable income stream that survives economic shocks and quietly outpaces inflation without you having to constantly monitor it. Are you investing to build a sustainable future, or are you just buying the illusion of a paycheck today? If you like looking at money without the myths, stick around.